PayPal just shocked the market. One stock, one day, more than 20% gone. PayPal crashed to prices not seen since 2017. And this was not caused by one small issue. It was a full confidence breakdown. If you own PayPal, if you watch PayPal, or if you are hunting beaten down tech stocks, you need to hear this. You need to hear this. Now pay attention to this. The day started ugly. PayPal opened lower. Selling accelerated fast. Stop losses triggered. Long-term holders panicked. By the close, the stock was near $41. Billions of dollars in value erased in hours. This surprised Wall Street because PayPal was not supposed to behave like this. It was supposed to be stable, predictable, a mature cash flow company. Instead, investors ran for the exit. Here's why. First problem. PayPal reported its quarterly numbers. They were not terrible, but they missed expectations. Earnings came in below forecasts. Revenue also came in light. In this market, that is enough to trigger selling. Because investors are no longer paying for the past. They are paying for future growth. And that is where the real damage happened. PayPal's guidance scared the market. The company told investors not to expect strong growth in 2026. Earnings could be flat, or even slightly lower. That sentence alone crushed confidence. A global payments giant basically saying, do not expect growth next year. That is when institutions started selling aggressively. Here's what could happen next. When guidance collapses, valuation collapses with it. But it gets worse. PayPal's most important business is branded checkout. This is the high margin business. This is what investors care about most. Growth here almost stopped. Nearly zero growth. That means fewer people are clicking the PayPal button at checkout. Competition and Pay, Google Pay, native checkout systems. PayPal is losing share. And Wall Street hates one thing more than bad earnings: market share loss. Now pay attention to this. Just when investors thought the news was done, another bomb dropped. PayPal is changing CEOs, and not in a calm transition. The board said execution was not fast enough. That line scared investors badly, because sudden leadership changes signal internal problems. Markets hate uncertainty, and PayPal now has a lot of it. After this, analysts reacted fast. Price targets were cut, gradings were downgraded, and some analysts openly said 2026 will be another transition year. That confirmed what the chart already showed. Confidence is broken. But here is where things get interesting. PayPal is not failing. The company still generates massive cash flow, and it plans to buy back billions of dollars in stock. That means management believes the stock is cheap. But Wall Street is not convinced yet. So what does this mean for you? If you are a long-term holder, this hurts because the story changed. PayPal is no longer a growth stock. It is a prove-it stock. If you are a trader, volatility is here. Bounces will be sharp. But risk remains high. If you are watching from the sidelines, this could become a classic turnaround setup, but only if growth returns. So here is what to watch next. User growth, checkout volume, and execution under the new CEO. If those do not improve, this stock could stay cheap for a long time. But if PayPal regains momentum, this crash could look like a once-in-years opportunity. So let me ask you, and is PayPal a fallen giant ready to rise again? Or a company slowly losing relevance? Bull case or bear case? Tell me in the comments. Because this story is not over.